In this episode of Power Charting, we are going to do a distribution workshop. Why do that now? Well, it's always a good idea to talk about distribution because it happens, rotation occurs in and out of industry groups, the market, and so on. There are other reasons at this time to talk about distribution. And so just as a review, well, first of all, we are going to talk about the current market for a few minutes quickly, then distribution workshop, and followed by case studies. So obviously I have more to do than I have time to do it in. Here is a schematic for the business cycle or the investment cycle. This is typically a 4 to 5 year phenomenon. Lately, I think they've been longer, but here is the accumulation area. And in the accumulation area, there is a structure of charting that leads to the markup. We count the point and figure count across this accumulation area. At the distribution area, this is when prices and markets have gone to extremes. They're overvalued, they're overloved, they're overbelieved, and distribution starts to set in. And this will produce a subsequent markdown. And this markdown will go on until you get back into an oversold condition again. So here we go. We're going to talk about distribution. But first, let me announce that there is going to be a Best of Wyckoff 2021 online conference on April 9th. And this conference, you can go to wyckoffanalytics.com, wyckoffanalytics.com, go in, read about it, find out who the speakers are. This is like the 7th annual conference. This conference was originally started by Dr. Hank Pruden, and Dr. Pruden did a wonderful series of these, and in the first few years, subsequently, he passed, and we want to keep the Best of Wyckoff theme alive because it's a wonderful event, and all in the memory of Dr. Pruden. It is absolutely free, so you have to attend. It's going to be about 4 hours in length. I will be one of the presenters during that conference, and there will be many others that are all super talented. So be there. Now, just looking at this point and figure chart, this is a massive point and figure chart that encompasses the entire accumulation area going back from around 2011 to 2008. And this accumulation, now there's 3 of them here, leads up to this count here, which went up to, this is 180 on the DIA, Dow Jones Industrial ETF. And look how beautifully it captured this pause that was more than a year in duration. This count here went right up into the area of the 2018 to 2020 trading range, had distributional qualities, and then the breakdown into the COVID low. The third count, which is the mega count, arguably the biggest count we could take, goes up to a count of 310 to 350 with a current high of 332.18. And this is a mega count, and we have fulfilled it, and we are in the middle of this target range. This was a count that was inspired by Dr. Pruden. He wrote an article on this very bold call that there was going to be a bull market back in this 2009 area, and then he wrote that around 2011. But this call where the Dow Jones could climb up to this 18,000 area was a phenomenal call. It was amazing. So here is the Standard & Poor's 500 ETF, SPY. I've shown you these charts before, and you can see here that this count, the larger count, goes right into the middle of this range, which the most recent high, 398.12, goes right into the middle of this target range and is really a very large point and figure count. Here is the triple Qs. I'm not sure we've looked at this one. This count is a very large base. It actually is bigger. This goes back to 2001, if you can imagine. And this count, and look at the beautiful accumulation area. This count counts all the way up to 325. We have thrown over that area to 338. And so not uncommon to throw over. Not by much, but it has done that, and we will watch for its correction back into the target range and possibly below. The other thing I want to show you is the 10-year decennial pattern. I've talked about this at the beginning of the year, talked about presidential election cycles and why we could have a condition where we could have a classic cyclical recessionary condition. And here is the 1 year. This is the year that we're in. I said at the time that I thought we could be in a trading range into mid-year. And this, I think, is what we could be looking at going into the summer, maybe into the fall. And then notice that it's a resolution into a downtrend. So this area here, I would describe on this cycle chart as a possible distribution area. And so, and leading to about a 12-month bear market. And again, these are cyclical, and what we're trying to do is we're just trying to identify the possible tendencies of the market. We're going to use our classic Wyckoff techniques of trend following and tape reading to identify these these areas. Okay, so let's get into the current market a little bit. I just have a few things that I want to show you, and I'm going to do this very, very quickly. Here you'll notice in the S&P 500, and this is the New York Stock Exchange Advanced Decline. This is a 4-hour chart and with 5 periods smoothing. Now, so we do this because it's a little more sensitive. Now notice here that these lows are all higher lows. I think that's constructive for the S&P and could be a sign that the S&P is going to want to consolidate and maybe attempt to rally back to the highs, possibly be longer. We'll watch for that, but we're somewhat oversold. And notice the higher lows here between these 2 points and the lower lows that we have in the S&P in that same time period. So we'll keep an eye on that. Here is the S&P. On the left is that same New York Advanced Decline data 2-hour. And so you can see here, it's a little bit different look, but notice how well this rally has come off the low right here. And actually, this low was made while this data was already rallying. So that's a divergence of sorts. Also, these beautiful trend lines. We've looked at these in the past, but we first talked about the risk in the market on the rally up to the top of the channel. And then we looked at this attempt to rally up to the lower demand line of the channel, and it was rejected off of that and has turned down. So we'll see if this oversold condition and this divergence can produce some kind of an important rally event in, or at least a short-term rally event in the S&P. Here again, this is back to a 4-hour chart, and this is the advanced decline data. And just here you can see the divergence showing up and the desire of this breadth indicator to rally from a series of higher lows. These are all higher lows. Okay, NASDAQ stocks above their 50-day moving average. This is the NDX. And you can see that this has, in the NDX, we know has been really weak. Here you can see this breadth type indicator breaking down to a lower low here. And so this is daily data, but typically when you have that kind of a breakdown, that you're going to at least get a test of the lows, possibly go lower, so we'll watch for that. But you can see here the distributional nature. We're going to talk a little bit more about this in a minute. Okay, the comp, NASDAQ comp, this is a broader list of stocks here, but look at this breakdown in the NASDAQ comp. So when you compare them, say the NASDAQ comp or the NASDAQ 100 to the New York listed stocks, which are more conservative, have deeper value, have better dividends, this is evidence of rotation taking place. Well, look here. So here's a low. And this is an important point, that this low is confirmed by the low in price. This tells us, even though there's this big bulge here in the oscillator into this rally, that's a pretty good rally, that we would expect another attempt to go back down to the lows because they're just all confirming lower prices. So we have another lower low here. I would suspect that that means that we have a very good chance of getting back down to these lows for a test or possibly go even lower. Now, this is the NASDAQ, which is different from the S&P. And this is where much of the selling is taking place. And do note the distributional nature. As a matter of fact, at the time we were looking at this, we had said that this structure and this rally and could produce a more weakness and more volatility out into the future. And this is something you really want to work on, is how to visualize how things could unfold in price charts, classic Wyckoff technique. Here, now notice this was important in the Dow Industrials. This is a daily chart, big bulge in the Dow Jones up here to this 33,000 level, but look what happened, lower high in the bullish percent breadth indicator. And now notice how easily the breadth bullish percent breadth indicator is turning back down to its previous low. We'll see whether weakness can confirm and continue for a little while, but this is evidence of deteriorating breadth in the Dow Industrials. So with this, let's just pause for a second. I will be right back. I know that all you Wyckofians out there are familiar with these schematics. So we have schematics for accumulation, reaccumulation, distribution, and redistribution. And they are incredibly valuable to us as a roadmap to the phases of the unfolding of a structure. In this case, you can see here, phase A is the stopping of the advance with a buying climax. Phase B is a trading range, which is the construct of the composite operator systematically distributing stock out of their portfolio. Phase C is the final testing phase. Phase D is essentially the beginning of the markdown within the structure of the distribution range. And then phase E is the markdown phase. And so here is just a slightly different look in that the last point of supply, unlike the UTAD, does not go to a new high. It has a test and then fails from there. So one thing I would like to point out in these two schematics, and the way I think one of the most important techniques that you can learn here is that the buying climax, which is this accelerating price advance with volume into a peak that is followed immediately by an automatic reaction. And so these 2 points go together. So strong advance followed by an automatic reaction. You draw resistance across the top of the buying climax. You draw support across the automatic reaction, and that becomes the outer bounds of your distribution trading range for the foreseeable future. Now, the preliminary supply point here will look an awful lot like a climax, and that's because it is. It's an exhaustion of acceleration of price. The difference is that the sellers have not come in yet in size to stop the advance. Here they do at the buying climax peak. And so all these volatile reactionary declines off of the resistance area really all are the composite operator systematically selling as much stock as they can off of the resistance area. And that doesn't mean that it can't exceed the outer bounds, but it will soon come back into the range. Here is this life cycle model. Here is the distribution area. You can see here, and all this does is go back to our original cycles chart, which just shows in a truncated way the evolution of prices through the accumulation, markup, distribution, and markdown. And this is really a special chart that Ramon made. Then this particular chart, I think we just looked at that, so we won't go there. And now I'm going to stop again because we're going to go into some case studies. This is a very large structure in NFLX, and this structure is, sorry about goes back into 2020. So you can see that this is a large distribution. We're not going to talk about point and figure today, but you can see that there are 3 possible segments, maybe 4, 1, 2, 3, 4. And these segments could be counted. And I will tell you that this does represent a large count, which could be reaccumulation. It's too early to tell. And notice this, that NFLX has been making higher lows throughout here. And so until NFLX actually can show signs of a sign of weakness, I'm going to show you that concept in a second, we have to be on alert for that. But it's into this range of a pivot. And you can see that really, really well in the point and figure chart. But let's go into the structure of this. And so I think it's always good to look at both the point and figure and the vertical line chart. In this case, we're looking at the vertical line chart. And here, as we talked about, look at this dramatic buying climax run. Very dramatic with very high volume. And it results in a very sharp reaction, a most important reaction, which sets up the outer bounds. This exactly fits what we just talked about with drawing resistance at the top of the buying climax and support at the bottom of the automatic reaction. Secondary test, this is phase A, and then look at all the volatility that occurs in phase B. So now this is what we think is the final testing area called an upthrust after distribution. And the reason that we're thinking of it this way is because it occurs on news. It's a good earnings report, and then a reaction back in, a rally up to test resistance and fail, and then the ability to move down. And notice how this rally is better than this rally. This is more of a trading range. It's loose, volatile, and in the last couple of sessions, it's gone down pretty sharply. And it went down even though the market today did pretty much close unchanged. So this is a little bit of relative weakness. We're going to watch this to see whether or not it can get down to support. Again, holding in mind that these higher lows might in fact be potentially a reaccumulation, but this decline here has taken back virtually the entirety of this jump. And so that is not a bullish event on this chart. Let me just say something about distribution. Distribution is an important concept to know. And it's important because you may own stocks that are starting to go into a distributional type structure. Well, this is not necessarily as a matter of fact, I do not recommend short selling for most people. Short selling is a very difficult proposition. It is in many ways psychologically and tactically very different from accumulating or buying in an uptrend. So distribution requires a certain set of skills and for short selling purposes, but it's very important to a person who has ownership of these shares and is looking for the tactical position to be able to reduce exposure to these stocks as they go into advanced distribution. So here is a chart of the NASDAQ comp, not the one I wanted, this one. This is a 60-minute chart. This is the month of March. And I just want to point out on an intraday basis that distribution can be seen in all time frames. And here you can see the buying climax, the very sharp reaction. This is like preliminary supply here. These 2 points draw our trend line. Notice how it tries to climb back into the channel and then fails completely. Buying climax, automatic reaction, resistance and support, upthrusting action, what we would say is upthrust in phase B, and then a decline off of that upthrust that cascades all the way down to support and below it. Now, this is a very important concept of distribution, and that is the sign of weakness concept, because when you can decisively take out a prior low in the structure of the distribution before a rally ensues, that is classic sign of weakness behavior. Then you watch the next rally, because classically the next rally will probabilistically produce a last point of supply. And look at how this rally goes right up to the resistance area, and it stops there. Now, this is a really important resistance concept, because the buying climax is the moment in the chart when the composite operator type said, this is the place I want to start selling systematically, is at the buying climax. So it's a very important chart point. Then, so even though it goes above it in the next few rallies, notice how on the last point of supply, which is the second lower high in this chart, it produces a huge failure out and another sign of weakness. So we will look for another rally in here, and a rally of poor quality. And the rally in this advance, if this is in fact classic distribution, should be of less quality than the rally from the sign of weakness to the LPSY. Okay, let's just keep going here, because as you know, I'm always running out of time. Here is the NASDAQ 100, little different look from what we just saw in the NASDAQ comp. This is only 100 super high growth stocks. These are the mega cap names in the market. It's a very important index to follow. Look at the big gap here and then the run up into resistance. This buying climax is immediately followed by a reaction that takes back all of this move up, including the gap. That produces the support point, then a rally. This rally up thrust the resistance area, but notice this is really important. It comes right back into the range of resistance and support. has one attempt to test to a lower high of the upthrust and then cascades and fails right back down to support. So this is a classic place to be selling, is on the test that fails the upthrust here. And then here's our sign of weakness and a rally, just like the other, into a last point of supply, which is the resistance area as defined by the buying climax. And then an absolute failure down and out, another sign of weakness. And we will watch to see if the rally that comes here is of low quality, and it's possible that it might just be a sideways trading range, which would be very low quality. Okay, Autodesk. This is a stock that I've been trading in. It's a favorite trading type stock, and so I'm not recommending anything, and I'm certainly not recommending short selling or anything like that, but I think it's a very interesting case study. And so here you can see preliminary supply, kind of a climactic surge, very shallow reaction, and then up into what we're going to call the buying climax. Now the structure is very different. Why did I call this the buying climax? Simply because the reaction that came off of that was significant. So this decline from 320 down to 275 was deep and accelerated all the way into that low. Notice the reaction after the preliminary supply was actually exactly the point at which support was found and then another rally took place. Look at this beautiful trend channel. It's not very large, but these 2 points, and then this is the overbought parallel against that, and look at how it went right up and touched the buying climax. You can draw that trend line once you have these 3 points, and then off it goes. Beautiful advance. It's a great trade. And then here, this failure is a deep sign of weakness out of the area of the support zone. The rally is very poor quality, and notice how this is just simply a trading range. It's not even a rally. So this so far is looking pretty questionable. Akamai. I'll just show you these real quick because we are in our last 90 seconds. So buying climax, automatic reaction. Notice these 2 chart trend lines. This is a reverse use of trend line. And you can see here, this was drawn from like this trend line a couple of years ago. And so look at how it touches the buying climax. Beautiful. Look at how these trend lines work when you do them the Wyckoffian way. And then a big sharp weakness to the automatic reaction low, resistance drawn, support drawn, up thrusting action sideways, and then we get a couple more up thrusts here at the trend line. We're going to call this the up thrust, and then it has a failing test. And then after the failing test, it goes into the pattern up here for an up thrust after distribution, a test, and look how quickly this fails. So this is a minor sign of weakness. The LPSY is pretty shallow. And we'll keep doing this. So we'll keep at this, and we'll do additional studies on distribution probably next week. And so maybe we'll just dedicate the whole show to that. Let me know what you think. If you like the show, give a thumbs up. And if you like this topic particularly, let me know. Love to hear from you all. Have a great week, and thank you so much for being here.